when everyone and their mom, when your uncle that you haven't spoken to in 6 months is hitting you up, when your friends are hitting you up about a stock or crypto, that is the phase that he's talking about right now. Definitely. So that's phase number 2. All right, now continue.
What's up, everybody? Welcome to episode 23 of Rookie Mondays. Today we'll be telling you how the rich stay rich. They understand certain things that most people don't. So we're going to tell you what they understand about the banks. We're going to tell you what they understand about the stock market cycles. And we're going to tell you what they understand about bear markets in general, so you can know what to expect and how you could use your money. So let's kick it off right here, Noon.
All right, so the first thing is the rich understand how the banks work, and most of us actually don't, right? We're always taught just put your money into a savings account and sit back and relax. But let's actually understand how things work. First off, a bank actually wants to take advantage of you, right? It's very simple. So what they do is, if Rel is a bank, I will give him money, and in return, he's going to give me interest, right? Everyone thinks the interest rate is amazing, put your money in the bank account, but in reality, right now, the interest rate is actually 0.06. That's ridiculous. You're not even getting 1% for keeping your money in a bank account. But when I give Rel the money, he's taking that money and lending it out to someone else. And when he lends it out, he's charging a 5% interest basically on my money.
Or more.
Or more in some cases, which is crazy. So the bank, in this case, is always going to make money. They're just rotating and revolving all the money that they get and swinging it around every single corner. But me, as an everyday consumer, I think that I have my money in a bank account. So if I gave him $25,000, I'm like, yo, my $25,000 is safe. It's all good. Doesn't mean he actually has $25,000 in a physical location. That's not how it works. The money is always all over the place. In reality, you can only take out between $300 to $3,000 from your ATM. So you can't even take out the full amount. So that's why banks work in a different way, and the rich understand that, which is why they have a budget, right?
Yeah, for a fact.
And at the end of the day, their budget is very important to them. So they have an amount set aside for their expenses, an amount set aside for their savings, because you do want to save for a rainy day fund, right? And then they have an amount set aside for investing. Yo, haven't we been seeing like all these different pictures right now where like 50% is, needs, 30% is wants, and then 20% is what, savings? That's ridiculous. That's not what your budget should be. You're 50, 30, and 20. If you want to follow that, you got to be smart. You have to set aside money for investing and saving, and then your expenses.
Right. And we've talked about that at length in a previous Rookie Mondays episode. So if you need help in your budget, please go back. I believe it was episode 2 of Rookie Mondays.
Yep.
So make sure you please check that out. And what the rich understand about even like these rates we were talking about, bro, inflation, as we see, we talking about inflation near 9% right now.
Yeah.
So literally the money that you're making off of your savings account is so insignificant. You're actually technically losing money because everything costs so much more.
Right.
And so it's literally not even advantageous to keep it in your savings account, at least not all of it. Like we said, you need rainy day money, or even if you put it into a CD, because as you can see on this chart, like CD rates were way higher back in the day than they are now. And we're talking about, they used to get about 12% in their CDs, and now you're getting like less than 1% from a CD. So it's not even, like literally banks have just been finessing us for a very long time now, and it's about time we learn to invest just like they do.
Exactly. And honestly, let's just talk about this, right? For people who don't know what a CD is, certificate deposit. So very, very simple, right? When you put your money in a bank account as a savings account, you can take that money out. You have access to your money. However, with a CD, that's not how things work, right? Well, when you put your money into a certificate deposit, the bank actually takes your money and locks it for a certain time period. So you can do 30 days, 60 days, 1 year, 5 years. Obviously, the range varies, but that money is then locked away and you get paid interest. So as you just explained, back in the day, yeah, you were barely almost getting, 12%. Now that's not the case. So savings is not as advantageous today as it was back in the day. That's why our parents and even our grandparents kind of disagree with that. You know what I'm saying?
Yeah.
That's always a problem. I butt heads all the time, but that is what the rich understand. And that's just one piece. So the rich also understand investing. So let's break that down.
Yeah, man. Rich understand a lot about market cycles. The market works in cycles, people. This is nothing new. Like, yes, it goes up and down, but there's kind of a structure to it. So let's start with the accumulation phase, right? You know, you can reference Fred McAllen. He has a great book on this, Charting and Technical Analysis, where he goes in depth on this, right? Now, the accumulation phase is kind of like what we're in now, I would say, right? We're talking about near the bottom. You know, the market is moving sideways, all at the bottoms. Everybody's just like scared. There's a lot of blood in the streets. It's just like, yo, man, everybody's scared of the stock market.
Yeah.
You know, this is when smart money, big money, this is when they're buying. That's the crazy part. Like, the stock market gets sold off so heavy, right? And then we get the accumulation phase where all the big smart money is buying. And then when things start to raise up a little bit, now we enter the participation phase.
Right. Before he continues, I need y'all to understand what he just said very slowly. Accumulation, the most simple thing he's saying right now. This is when people buy. So when there's blood in the streets, that's when people are buying. I'm saying that super slow for y'all, just so you understand, don't panic, but continue.
Nah, for real, great point. And then, you know, so now when things start to rise up again, right, we start to see the stock market trend upward. It's called the participation phase, right? Because this is when most investors, right, you take a lot of retail investors start diving in this time period, the participation phase, because they're like, oh, let's participate. That's when you might see like your friend be like, yo, bro, this stock is starting to go up, and then you hop in, right?
Yeah.
Like this participation phase. So we're gonna see it rise up for a while, and then it starts topping out. And when it's topping out, guess what? We start to enter the distribution phase. So
1 point, right? Real quick. So you know how you just said something about that? It just reminded me, bro. Yeah. So Thanksgiving dinner, when everyone's talking about crypto, you know what I'm talking about? Back in the day, everyone's like, yo, crypto's at 20K, Bitcoin's going crazy, Bitcoin's at 20K, everything's going crazy. That is the phase that he's literally talking about right now. When everyone and their mom, when your uncle that you haven't spoken to in 6 months is hitting you up, when your friends are hitting you up about a stock or crypto, that is the phase that he's talking about right now. Definitely. So that's phase number 2. All right, now continue.
Exactly. Like, I just want to hone in on that for a second. It's a fact. Like, when people who never invested before, never heard a thing about investments, or all of a sudden talk about investments, like, I know you remember the time period, even in the pandemic, when everybody talking about every crypto in the world.
Yeah, 100%.
Right? These are red flags at a point, like, where it's like, oh, this is like, we're at like pretty much the top of the participation phase right now. If everybody's doing it, what do you think smart money is doing? They chilling because they actually accumulated in the accumulation phase so that they could do the third phase now, which is distribute, the distribution phase. This is when smart money, big money, starts selling to people like that we were just talking about, right? Like a lot of retail investors. And you start to see the market start to sell off, right? Because smart money has the most money. They really move the markets. Like, they really move the markets.
Like the actual institutions is what he's talking about, right? He's not talking about people like you and I or, you know, people that are watching. We're talking like real big money.
Yes, millions, right? Like, they that's why they move market. We don't really move market, like stock prices, excuse me. Like, remember that. Our little 1,000, 3,000 does nothing for the market. Understand that. So when smart money is selling, that's when you see the market sell off so hard. That's called the distribution phase, because they're literally distributing. And then eventually we hit the accumulation phase and we rotate. Okay, so understand that the market moves in cycles. So the best care for that is, like we said, we always talk about DCA, which is dollar cost average. Yes, you could buy on a daily or a weekly or a monthly basis, same amount every time. Yes, but have money set aside in your savings for the accumulation phase. Like, literally for the accumulation phase, you have to plan for that. And I know we talked about like the average amount of time for a bull market, right? The average amount of time for a bull market is 4 years.
Yep.
Right? And then you hit a bear market, and the average length of a bear market is 9.5 months. So don't panic in those 9.5 months if that's the accumulation phase, because you know you got 4 years of bliss coming up.
Exactly. So at the end of the day, when you DCA, you'll be perfectly fine. And the actual heavy allocation, what you were just referring to, the rich understand this extremely well. That's why they budget for it. That was our first point that we made to you, right? So just think about it. Right now, Warren Buffett actually came out and said his company bought more than 50 billion worth of things since the beginning of this year. Right? Just let that sink in. 50 billion with a B. So when he's doing that, he's talking about this accumulation phase. He's not trying to time the market. He understands how markets work. Yes, there's different cycles, but he's not trying to time it. Of course, if you buy something and it falls, it's all good. I still got a discounted price. All right. So that's just one example of someone who's extremely wealthy, probably the GOAT when it comes to investing, doing what he does best. And we can learn from that ourselves, right? But now let's just talk about something. You talked about bear markets and bull markets. So we want to keep you guys extremely calm right now and just give you guys an understanding of how things really work when it comes to this, right? So as you said, a bear market lasts anywhere from like 9.5 months, right? That's a bear market. And on top of that, it comes around every 4.5 years. So you have to be ready for when that happens. Right now, yes, we are in a bear market. It is officially there. Yes, I understand what's going on. There's madness everywhere. People are scared. Yeah, we get it. However, we just talked about a bull market and how long that lasts.
Yeah, and just, sorry to cut you off.
No, you good.
Just to say, like, we just had our longest bull market in history. Like, literally, from 2009 to 2020 was the longest bull market that ever lasted. It was 11 years long. All right, so we were overdue for this bear market, yeah, like overdue for it. Like we said, on average, you know, these bear markets come around around 4 years.
Yep, exactly. So let's just talk about this right now, right? I know you want to talk about the different bear markets and the different statistics, so let's dive into that.
Yeah, for sure, bro. Like, so if you go back to even like the .com era, from the top, meaning like the top of the market to the bottom of the market in that relative time period, in the .com era, which is about 2000 to 2002, it took 31 months from the top to bottom. All right, if you look at our current bear market, we from top to our recent bottom, because we don't know if it's done yet, I'm just saying, it took about 6 months. All right, so in the .com era, it took 31 months. So it ain't even that bad so far. All right, and they had a total decline of about 49% altogether. And it took 48 months for them to break even. 4 years to break even, bro.
When you think about it, it's scary, right? Again, that's the thing. It's only scary, though, if you don't understand what's happening. And that's what we want to tell you right now. The rich are not getting scared. They're just being smart right now. They're starting businesses that make sense for them because they have the money to do so, because they saved it, right? They are investing right now because the phase that we are just speaking about earlier. So you guys have to have a complete understanding of how things work and why the rich stay rich, why the middle class and the poor class honestly struggle. And I even hate using poor and middle class. I just don't like using those terms, but it's just a fact right now, right? So now that you guys have an understanding of it and it makes sense, make sure you take some action. You guys are using the DCA strategy we always talk about. You guys are budgeting. We have a free template that you could download in the link below. It's all yours to understand how things work for you. And if you have any questions, we have your back.
Yeah, and then just understand, people, like I said, you don't know when the bottom is. So I know I referenced the .com era and said it took 4 years for them to break even. If you look at the 2008 recession, the Great Recession, that took a little over 3 years to break even. And then, but if you look at the bear market we had in 2020 with COVID, that took 6 months to break even. So much quicker, right? So, and if you look at the entire chart, you'll see that it's different time periods. So nobody knows when the bottom is. So we don't want you to try to time it, but I do want you to just understand market cycle. And so even if you were to start buying in this stage right now when things are so discounted, you might go down a little bit more. Yes, we might not have hit the bottom yet, but I say the upside is way stronger than the downside potential.
Absolutely, no, 100% spot on, 100% spot on that. So hopefully that makes sense to you guys. You guys understand everything. Once again, any questions you guys have, just comment below, hit us up on Instagram, and we got you. Make sure you guys like, comment, and subscribe to the channel because we got amazing stuff coming for you. Plus, hit that little notification up because we got
2 videos a week.
And you don't want to miss them, all right? Make sure you check out our video on Wednesday. But until then, peace.
Peace.